Welcome to another session of Business Startup Training. Today we're going to look at an exciting topic of depreciation using Xero accounting software. This is an important and exciting topic, and I've been teaching it for many years, and I'm going to share it with you. Like, share, subscribe. Okay, let's get into it. Now, first of all, let's talk about what is depreciation in terms of the principles. But before I actually talk about depreciation, let's talk about what it is we're going to discuss. So we're going to discuss defining depreciation. Then we're going to move on to the asset in terms of the ledger. We're going to implement it in the ledger. Then we move on to how Xero does it in terms of that whole ledger experience. Then we move on to the depreciation expense and the ledger, the disposal of an asset, Xero disposal of an asset, and then we'll conclude. Okay, now let's define depreciation. Depreciation is defined as the reduction in the value of an asset over time, due in particular to wear and tear. So we know it's a reduction in the value of an asset over time because of wear and tear. So the asset is not going to always look good. It's not going to always be excellent and it's A1. It will lose its value over time. And therefore, we account for that in terms of accounting by this method of depreciation, where we capture that devaluation of the asset via putting that devaluation in the income statement and representing the current value of the asset in the statement of financial position. All right, so that's an important principle. Now, it is important to note that the accountants use this word provision. It's an important word. Provision is where we provide for or prepare for the devaluation of the asset. This is an important concept. And as we said earlier, it's reflected in the income statement and the statement of financial position. Now let's look at an example. Okay, so Mark bought a van on the 1st of January 2016 and for his removal business, and he hopes to have the asset for 5 years, and the asset costs $25,000, and he'll dispose of it for $5,000 using 20%. And in depreciation, we have two methods. We have the reducing balance method and the straight line method. Here we'll just talk about the reducing balance method. So now we need to look at the information. It involves some calculation. Now, if it is that you have not done accounting before, you might get a bit of problems understanding the principle. But I'll try to be as skillful as I can to navigate the challenges that you may encounter while going through this principle. But there are three main areas we need to consider when we're talking about depreciation. First, we need to consider the cost of the asset, which is what the asset was bought for at a particular point in time, its original value or its invoiced value. We need that. Then we need to consider the depreciation, which is the valuation of the asset at a specific period or point in time. Then we need to consider the aggregate or the accumulated depreciation of the asset at a specific point in time. And then we need to consider the net book value, which is the current value that we, the business, assumes based on our prudent calculation of the depreciation, what the asset is worth on our books. Okay, so again, the principles are: 1, what the cost of the asset is; 2, what the depreciation for the period is; 3, what the accumulated depreciation is; then 4, what the net book value, which is what the asset is worth at a particular point in time. Now, with this example, the cost of the asset we know is $25,000. And
20%, not 25%. Change that.
20%. So 20% of 25,000 is 5,000. And then 20%, now before we get the next, for the next year, we need to find the net book value or of the current year. So 25,000, we know the depreciation for the period is 5,000. So the difference between 25 and 5,000 is 20,000. Now, so 20,000 is the net book value after year 1. So we need to find 20% of 20,000, and that gives us 4,000. And then the net book value of that would be 16,000. And then we find 20% of that, which gives us 3,200. And that's a depreciation for year 3. And then we find the difference of that, and the net book value of that is 12,800. Then we find 20% of that, which is 2,560. Find the difference of that, and that gives us 10,240. And then we find 20% of 10,240, and that gives us 2,048. We find the difference of that with 10,240, and that gives us 8,192. So 8,192 is what we view that this asset is worth on our books. Now, it is important to note that the asset is going to be sold, or we have a buyer that would like to purchase the asset for 5,000. So there's a difference between what we, the business, assume the asset is worth, and what external people, which is people in terms of in the public, or the sellers, or rather other buyers, assume that the asset is worth. So there's a difference there. We're going to talk about that a little bit later on. Now, we also need to consider the principle of the double entry. Okay. Now let's talk about the double entry principle. The double entry principle here, we need to actually capture the fact that we bought the van. Now, when we buy an asset, we consider the principle of it being a debit because we receive the asset. So when we buy an asset, it's a debit. When we lose an asset, technically we consider it to be a credit because we're losing it. But here we buy the asset, which is a debit, which means we're receiving the asset. But the credit here is that we've lost money. So the debit would, in the asset account, which is normally a debit account, we would receive the asset there. And in the bank account, we would have lost money, so we would credit the bank account. So that's the main idea in terms of the principle here, the double entry here. Now that is also, we can reflect that in Xero. Xero actually shows the principle where you add a new asset, and you can see the icon here. And here they have added desk, chairs, in the reception area, etc. So they've actually added an asset, so you can add it. Now, when you're adding assets in Xero, you need to, first of all, in order for you to add the asset, because one of the important features of Xero is that it gets information from the bank feed. So when you buy the asset, providing you've actually bought the asset with the cash that you have within the business, the information would have been in the bank feed. Then you are able to take that information from the bank feed and assign it to the fixed asset register. When you assign it to the fixed asset register, you can then register that asset and choose the method of depreciation you intend to consider that you're going to use in terms of this particular asset. So that's an important principle to note. So number one, in terms of Xero accounting, we need to know we've bought the asset. If we bought the asset, it would be reflected in the bank account. If it's reflected in the bank account, we are able to then import the information from the bank account, because Xero has a bank feed. It connects to the bank feed. We can import the information from the bank feed into the actual accounting software itself, registering the asset, and by registering it, we would debit the asset account, and then by default the bank account would be credited. So that's the main idea. Now, we may need to have a part 2 of this. I'm actually going to do a part 2 of this. So we're going to continue this main principle of depreciation. So like, share, subscribe, and look for the next one in terms of the concept of depreciation.